Welcome to The Explainer. Today, we're unpacking a massive, undeniable contradiction sitting right at the absolute center of the current market. We're going to look at exactly why crypto's underlying infrastructure is maturing at this blistering pace, even as capital flows appear remarkably and, honestly, kind of confusingly weak. So let's just dive right into this paradox.
We're jumping straight into the hard truths today. As the quote goes, crypto does not need more applause, it needs harder questions. And man, is that true right now. Because the reality is, the easy story era in digital assets, that era where you could just clap for literally any new project that had a shiny logo, that's officially over. The market is demanding actual, real substance.
Just consider the paradox we're seeing right now. On one side, headline numbers are basically screaming failure with these massive capital outflows. But then, right behind the scenes, the foundational infrastructure, the actual rails of the industry, have literally never been stronger. We're seeing intense regulatory clarity. We've got traditional banks rolling out stablecoins. It's a total, complete divergence between market sentiment and actual market structure.
To really grasp the sentiment side of things, we only have to look at this past June. It brought a pretty harsh reality check. U.S. spot Bitcoin ETFs actually experienced their worst month since their highly anticipated launch, bleeding roughly $4.5 billion in net outflows. $4.5 billion. If you only looked at the single metric, you'd probably think the entire digital asset space was in full retreat.
But here's the thing. Those outflows aren't the whole story. Not even close. Capital just isn't blindly following hype anymore. The phrase rails up, flows down perfectly captures this current dynamic. Structure is rising. We are witnessing a highly disciplined, institutional-grade build-out of crypto infrastructure, even as that speculative liquidity rotates away. The capital is getting vastly smarter, and the ecosystem, it's getting so much more robust.
Section 1. Europe's hard regulatory era. MiCA reshapes market structure.
Let's look at how this plays out in practice. Today, July 1st, 2026, marks a truly massive turning point in Europe. The EU's MiCA grandfathering period has officially ended. What does that mean for us? It means unauthorized crypto asset service providers face immediate product restrictions and forced client migration. Take Binance, for example. They have been the most visible case of a giant hitting this deadline without authorization, which really highlights exactly how strict and unforgiving this new reality is. They are being forced to adapt or fundamentally alter their European operations. The grace period for compliance? Yeah, that is definitively over.
So the absolute crucial point here is this. Regulation is no longer just some compliance checklist for the legal department to sign off on. Regulation actually is market structure now. This shift is going to fundamentally consolidate power around large, well-capitalized, and fully regulated firms. Licensed platforms now have a massive distribution advantage, which completely changes who gets to play and who gets to win in the European market. It is a moat built entirely out of red tape, and only the most compliant and deeply capitalized players are going to survive it.
Section 2. The Stablecoin Power Shift. The Battle for Reserve Economics.
Moving on to another massive infrastructure leap, we're witnessing a total reinvention of global value transfer models. And it's being driven by two completely different visions. On one hand, you have Credit Agricole's EORUST. This is a MiCA-compliant Euro stablecoin that brings traditional bank-grade settlement directly onto Ethereum. But pushing right back against that, you have OpenUSD, championing this shared network-driven reserve model built for global payments, all backed by a huge coalition of fintech and crypto partners. These aren't just tokens anymore, guys. They represent competing philosophies for the entire future of digital settlement.
And this clash of models raises what might be the most crucial question for the next decade of digital money. Who actually deserves to capture the reserve economics? I mean, should the yield from these billions of dollars in stablecoin reserves just go to the issuers, the banks, maybe the wallets? Or should it actually flow back to the merchants and the everyday users who are driving the adoption? Stablecoins just aren't digital dollars anymore. They are highly competitive business models fighting tooth and nail for global settlement dominance.
Section 3. Tokenization's reality check. Architecture over assets.
Next up, let's look at the push to put real-world assets on-chain. We hear constantly about the inevitable scale of tokenization, right? We've got firms like Securitize moving closer to a potential public NYSE debut. But actually surviving on-chain usage, that requires way more than just a good idea. Tokenized assets absolutely demand 3 flawless layers to function. You need clear asset rights so everyone knows exactly who owns what off-chain. You need perfectly reliable market data to keep pricing accurate down to the millisecond. And you need bulletproof wrapper and collateral logic to ensure the asset behaves exactly as intended in the decentralized finance. If even a single one of those layers breaks, the entire system collapses.
And unfortunately they occasionally do. Recently, Edelfinance had to abruptly pause its lending protocol because a wrapped tokenized Google stock mechanism completely failed. This glitch falsely inflated collateral values by roughly 78 times. That instantly created $403,000 in bad debt, quite literally out of thin air. It's a pretty stark reminder of the absolute absurdity that can happen when traditional assets collide with experimental code.
Now, you might be sitting there thinking, well, in the grand scheme of crypto, $403,000 is a pretty small drop in the bucket. And honestly, you'd be right. But the really important lesson here is the architecture, not the dollar size. It powerfully exposes that the entire risk stack, we're talking the smart contracts, the oracles, the wrappers, they have to be absolutely flawless before these systems can even think about safely handling billions in traditional institutional capital.
Section 4. The New Treasury Discipline, Date 2.0. And this exact newfound focus on structural integrity, it is absolutely bleeding into corporate balance sheets right now. That era of a company simply announcing, hey, we bought more Bitcoin, and then just watching their stock price soar, yeah, that's fading fast. The market is no longer impressed by pure conviction plays that lack financial discipline. Investors are aggressively demanding answers to some really rigorous questions now. They want to know, what is the actual reserve policy? What happens when the premium to net asset value compresses? Are these buybacks actually accretive to shareholders? Are the dividends covered? And is the per-share asset growth mathematically real? It's a total fundamental shift from pure hype back to real fundamentals.
We can actually see this new discipline in practice right now with Strategy's newly announced Digital Credit Capital Framework. They aren't just out there hoarding assets blindly anymore. They've systematically allocated a $2.55 billion USD reserve. They've got up to $1 billion set aside for common stock repurchases, another $1 billion for digital credit repurchases, and a targeted BTC monetization program of up to $1.25 billion. They are treating their treasury like a highly disciplined traditional capital structure machine, not just some speculative vehicle. Literally every single dollar is mapped to a very specific corporate finance strategy.
Section 5. End of the easy era. Speculation versus infrastructure.
Which brings us to our final point today. We really have to contrast this incredibly mature infrastructure build-out with the fading attention economy. Look, highly speculative meme platforms on Solana definitely still exist, but they are increasingly serving as just a cautionary tale. Instead of showcasing any sort of sustainable technological growth, these token launches are exposing extreme wallet concentration, incredibly thin liquidity, and just massive volatility. The contrast between this sort of casino environment and those bank-grade European stablecoins we talked about earlier, it honestly couldn't be starker.
Ultimately, the main takeaway here is clear. Weak business models are getting ruthlessly exposed. As the broader market stops being so generous with all that free-flowing liquidity, projects that lack real utility, transparency, and just basic operational discipline are quickly being filtered out of the ecosystem entirely. That rising tide that used to lift all boats, yeah, that is gone for good.
So, as we watch the underlying rails get stronger, the regulations get tighter, and the capital get so much smarter, I want to leave you with this final, lingering thought to consider today. Are we truly building the next generation of global financial infrastructure, or are some parts of this industry still just packaging pure speculation with slightly better branding? The infrastructure is clearly saying one thing, but the remaining speculation says another. It's really up to you to spot the difference. Thank you so much for joining me for this explainer. Keep asking the hard questions, and I'll catch you next time.